Today, a spotlight on Hunters Hill. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Well, two interesting conversations I've had this week. Firstly, from one follower who said, "You're not reporting so much on property as you used to. Why?" And I said, "Yes, I am." So here's an example of reporting on property. And the other conversation related to property in and around Sydney, and specifically in Hunters Hill. And it went like this. Well, I've been waiting for prices to fall in Hunters Hill houses, and in fact they're going up. So what's happening? So today I'm going to do a deep dive on Hunters Hill. And I think this makes the point very clearly that you must go granular. You cannot take generic price movements, be they positive or negative, and apply them to multiple postcodes. You have to go granular, which is why this particular type of analysis that we're doing is so critical. Now, I should just start by saying, as normal, this analysis is based on current available information and it may change. It's not financial advice and our conversation should not be taken as such. We're just looking at the data from our surveys and economic modelling, and the information is for your personal use only, and it will change ahead. And that said, this is an example of our DFA One To One conversations, where it's possible for an individual follower to have an individual discussion with me. And whilst I can't give specific financial advice, I can discuss my data for a given postcode and look at the underlying trends. I can assemble stress, home price, trend data, and extract a view of price trends ahead based on my modelling. And it's possible for you to book a time for a Zoom or a phone discussion, which generally takes between 30 and 50 minutes, although it sometimes goes up to an hour. Now, if you're interested, you can contact me by my blog. Details are below. And spaces are quite limited. We're booking about 3 weeks ahead at the moment. And I need to warn you that there is a cost for this. It's $250 plus GST, which is payable in advance. Again, I can send you details. Just contact me via the DFA blog. And as I've said before, and I'll just quickly recap again, we survey households, we pull information from multiple different sources, and all of this data goes into our core market model, and the core market model then provides us with information to support our industry modelling and the blog, individual client assignments, and also the DFA One To One. And the data we get back is very current. We have data from our surveys coming back each Tuesday. And so the model is updated very, very frequently. And one of the things we can do with our model is to take our mortgage stress data, the price trajectory, the history data, the buying and selling intentions, the migration data, and broader economic information like wages, employment, and CPI. And all of that goes into the core market model. And the core market model also has within it multiple scenarios that allows us to look at different potential outcomes. And we can look at that at a postcode level, roll it up to a region, a state, or to all Australia. But today we're going to go down to a postcode level and look at the dynamics there on the ground. And the postcode in question is Hunters Hill 2110, so it's obviously New South Wales. Hunters Hill is a suburb on the lower north shore of Sydney in the state of New South Wales. Hunters Hill is located 9 kilometres northwest of Sydney Business District and is the administrative centre for the local government area of Hunters Hill. And here is a map of the area. Hunters Hill is a significant promontory, grades down to Woolwich at the end here, and is connected via the Burns Bay Road. And here is Burns Bay Road. It's the main entry and exit route by road. It can get quite busy at certain times of the day. Hunters Hill itself is a much more quiet, green suburban area and contains a number of rather remarkable old buildings, including sandstone buildings. It has a long history, of course, and is regarded as a relatively quiet area. There's access to the ferries, which means that access to the city is possible other than by road. There are no trains coming here, and water views are available in all directions. Here you can see the view over towards Sydney. And walking around the area, there are many green streets Many large properties, some old ones, and many newly developed ones, often quite hidden away. And if you go down towards Woolwich, you then come across the Woolwich docks and the view across to the other side of the water. But it is a quiet location, very upmarket, and there are many, many very expensive houses in the area. Now let's just start by looking at properties for sale. We'll look at houses and units, and at the moment there are about 24 properties for sale in 2110. And here is the map. You can see that the middle of Hunters Hill is here, and it spills over to Woolwich and up towards Ryde here. And I have to say that most of the properties are auctioned, not least, of course, because they tend to have quite significantly high values. And it's also worth noting that the majority of the properties for sale are houses, but there are some units too. And I spoke to one of the agents in the area who did confirm that there is a very significant interest in properties in the area. Lots of people always come to have a look, see what's going on, although attendance at recent auctions has been somewhat quiet. There are a few expressions of interest and price upon application properties as well, but auctions clearly are flavour of the month. And one of the little tricks here is, of course, that there in some cases will be interest in the plot of land rather than the building itself. And we also know that in some areas of Hunters Hill there have been issues with old industrial workings and industrial contamination, which is causing a headache in some areas. There are a few apartments too, and some townhouses in the area, and there has been some recent subdivisions in some areas as well. Now, in terms of sold properties, about 25 properties have sold in the last 8 weeks in Hunters Hill, and here is a map. Once again, there's a relatively small count in the real part of Hunters Hill, some down towards Woolwich and some up towards Ryde. And here is some information on recently sold properties. Very little disclosure, but last asking price 18.5 million. Well, that was not your average property, obviously. Asking of 2.25, last asking of 6.4 to 6.6 million. And you can see there that the price tickets are pretty extreme in some cases. But again, little disclosure of real price. It's all last asking price. And as you know, I've said before, most often when you see last asking price, it has very little to do with the settlement price. And even some apartments are relatively expensive. And one of the points I should make is that prices do vary from one end of the postcode down to the other. But you quite often see prices of $4 to $5 million or more. So let's look at current trends. We're going to start with units. And in 2013, the median unit price was $775,000. Today, it's $930,000. But there have been significant movements up and down since then. In 2014, it went up 23.9%. It fell 23.4% in 2015, back to $735,000. Then it rose again up 27.2% to $935,000. Then it fell again in 2017, down 5.9%, rose significantly in 2018, and fell in 2019 by 34%, and then rose this year up 20%. Now, part of this is to do with the very low volume of transactions. So median prices, when there are small numbers of transactions, are of course less indicative. But nevertheless, overall, we can say that the average gain is 5.5% between 2013 and 2020. Hasn't doubled, certainly. And after inflation, the average is 3.6%. Turning to houses, the median price in 2013 was $1.6 million. Today, it's $3 million. And there's been a pretty steady rise, certainly in 2014 up 24%, in 2015 up 25%, in 2016 up 12%, in 2017 up 1.8%, it fell in 2018 down 3.5%, it fell in 2019 down 1.5%, and it's risen 10% this year to 3 million. And that gives an average gain of 9.1% between 2013 and 2020, or after inflation, 7.1%. And this trajectory is pretty firm, and it's certainly validating that conversation that I had with one of my followers that prices are on the rise in this postcode. However, the Value General data probably provides better information with regard to settlement prices. Here is the information for houses, and you can see that across the whole area, prices do vary: 3.6, 5.6, 7.9, 5 million, 4 million, another 5 million one there, 4.3 million, 7.7 million, and as you go down the list, you can see more 5s and 6s, and even an $11 million property. I'd also highlight that there are a couple of weird transactions where clearly transactions were not made at the market level. And this is the point, of course, that in this sort of area, there's a massive variety of prices, from very expensive properties to less so. So the median doesn't really tell you the full story, and I would recommend looking at the Valuer General data on recent transactions in and around the area you're looking, if you're looking in this area. The unit information is somewhat more limited because there are less units there and less transactions, but once again, we can see the considerable price variation: 1.4 million, 759,000, 2.6 million, 1.6 million, 1.2 million. There's a 5.8 million there, which looks like a significantly large price, but it's probably a significantly large property too. And so it goes on. So let's look at the summary findings overall. Currently, there are around 55 properties listed, with 30 added in the past month. And the agent that I spoke with did confirm there's been a considerable lift in listings, and he also believes that there will be more listings after Christmas and in the new year. Back in May 2019, listings were lower, around 45, and across the postcode, 65% are houses and the rest are units. Now, looking at investments, gross yields on houses are around 2.5%. That's a fall from 3.3% last year, and the net yield is around 1.5% and is falling. Whereas units, gross yields are around 4.2%. That's a rise from 3.8% last year. The net yield's around 3.15%, and that's rising. And the rents for houses are rising, up about 30% in the past quarter. Now, again, the volumes are quite low, so just be a bit cautious about that, but nevertheless, it's on the rise. Typical rent of $1,320 per week, whereas rents for units are falling, down 9% in the past quarter, with a typical rent of $480 per week. The vacancy rates are currently around 3.3% compared with 4% last year, and there are around 30 vacancies currently reported compared with 41 back in 2019. Asking prices for houses are on average flat to falling. In fact, down 7% over the past 3 months on average, with a typical house price of around 2.45 million. But of course, there is considerable variation, as I showed earlier. The average settlement is about 4% lower than asking. Now, turning to units, on average, their asking prices there are falling or flat, actually down about 3.5% over the past 3 months, so a little bit on the downside, with a typical unit price of around $370,000, and the average settlement is around 5% lower than asking. And interestingly, the intention to sell is rising slightly according to our surveys. Now, turning to our stress results, there are only around 3,600 households in this particular area, so that's quite low. Around 1,400 are borrowing, about 1,300 are renting, and there's just around 1,000 properties for rent in the postcode. The number of rental property owners, property investors, is quite high at 1,600, and many of them will hold properties in other postcodes. The overall financial stress metric is 41%, which is medium to high. Certainly, there are a number of households in some difficulty at the moment, particularly some with mortgages. Around 22% of households actually have a significant issue with mortgages. And actually, if you look carefully, mild mortgage stress, meaning mildly underwater, only 108, whereas 206 are actually severely stressed. Now, those severely stressed households are actually experiencing considerable issues because of changes in employment and income, and the fact that the mortgages are pretty big because the properties themselves are costing quite a lot. The risk of default is actually quite high too, at 4%. That's significantly higher than the national average, and we expect to see defaults of around 60 over the next year or so. Rental stress is not too bad at 44%. That's slightly higher than the national average. There's around 500 to 600 households in rental stress in the area. And investor stress is 56%, which is a little bit higher than many other parts of the country. In fact, the average across the country is around 25%. So there are a lot of people here experiencing difficulties with investment property. Now, the selling scenarios are coming from 3 quarters. The first quarter is people with mortgages who know that their income has been permanently damaged and that their principal and interest repayment holidays are coming to an end over the next few months and will need to sell. So I expect to see more mortgage properties coming onto the market in the next few months. Secondly, property investors are also finding that the returns are pretty low, and as a result of that, a number of property investors are looking to divest investment property. And thirdly, there are a number of people who have had properties in the area for a long time and have seen prices now rise quite sharply. And so they're contemplating whether they should sell and extract the equity, fearing that prices might correct further later. So put all that together and we expect to see a considerable rise in listings over the next few months. So finally now we turn to our price scenarios, and as always we look at our low, base and high scenarios. The low scenario is the most bullish, meaning that the economy comes out of its COVID phase quite quickly, the international borders open and things start to motor. In that scenario over 3 years, we definitely believe there will be price rises for units in the area, up about 4% over 3 years. So not massive, but some rise. On the other hand, if the virus really reasserts itself and we remain in a state of financial stasis for longer, it means that prices are more likely to fall. And in that scenario, we could see prices falling perhaps 26% over 3 years. But my base case, my mid case, is a significant fall over the next year, and then nothing much at all the next 2 years, giving an 11% fall over 3 years. So in my mid case, there are some falls, but not dramatic for unit. Now let's apply that to real prices. 930,000 is the average price in 2020 in median terms. 11% fall would take it back to $823,000, and in 3 years' time prices would be around $827,000. That would put prices back where they were in 2019, or indeed in 2016 and 2017, or indeed where they were back in 2013. So whilst there might be a bit of upside, units look to me to be relatively unpredictable at the moment. So let's now look at houses, and here there are definitely chances in the best case scenario of rises, but only relatively small ones in my view. 1.8% over 3 years. In the downside, prices could fall, and this year, 2021, and over the next 12 months to 2021, could see the most significant fall, with prices perhaps 16% down over 3 years. My base case, though, is a fall of about 7% in 2021, and a very small fall in 2022, and a recovery in 2023. So if we apply that to houses in the area, currently around $3 million, and a fall of 7% would take prices to $2.7 million, back to $2.717 million in 2022, and up to $2.77 million in 2023. And if that was to occur, prices would still be on average higher than in the period of 2016 to 2019. And of course, if you have a more bullish view on the economy, then those rises would be stronger still. And so there you have it, a really interesting study in this area. There is considerable demand for properties here, and that demand is coming from both local purchasers, interstate, and even a few international purchasers. And Hunters Hill has a bit of a unique environment and atmosphere that means there is always going to be prestigious property for sale there. That said, our modelling suggests there will be more supply coming on stream over the next few months, and whilst we have seen some price rises in recent times, I wonder whether they are sustainable, and over the medium term I think it's more likely that they may come back a little. But that said, even if they do come back, they're not going to drop that far. And Hunters Hill is going to maintain value into the medium to long term, in my view, simply because of its location, the mix of properties there, and the fact that it is just seen as one of the places to live. Now, if you compare that with some of the other postcodes in and around Sydney that we've looked at recently, you can see that this is a whole different ballgame. And this does, of course, underscore what I keep saying. You have to go granular to understand what's going on. Any of these high-level indices are meaningless. And just before I go, a quick reminder that on Tuesday at 8 p.m. Sydney time, we'll be running our next live stream, and there we'll be discussing first-time buyers, and specifically whether they should buy or whether they should wait. And I'll be joined by Veronica Morgan, who runs the First Time Buyer Academy, as well as a co-presenter on The Elephant in the Room. Of course, she also presented Location, and is a property buyer. And she'll be joined by her colleague, also involved in advising first-time buyers. So we're going to get some very explicit advice on Tuesday, and you can ask a question live. The links are below if you want to send in your question beforehand, or come in on the night and ask the question in the live chat. I look forward to seeing you then. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.